The markets regulator SEBI has recently come up with an order dated 3rd July 2025 saying that Jane Street has allegedly made profits worth more than 43,000 crores in the last 2.25 years by manipulating the markets through index options. It becomes very important for us to understand what happened in this case because there have been crores of Demats account opened in the last 3 to 5 years and more than 131 lakh crore rupees of investors, traders' money has been lost and more than 131 lakh crore worth of rupees has been lost by individual traders in the last 3 years. So how do these big con trading firms who have crores of thousands of crores of capital manipulate the market to make profit at the expense of Indian retail customer? Let us understand in this video. To oversimplify, there are 3 ways of making money in stock market if you are betting on a share price going upwards. Say if you believe that the stock price has to go up from 100 rupees to 110 in a very quick span of time, say 2 to 3 days or 4 days or 5 days, then you can buy, first option with you is to buy it in the cash market. That is, you invest 100 rupees and 3-4 days later when it gets to 110 rupees or more or less than that, as per your choice, you can exit that, right? Say you made 10 rupees on that, so your return on investment is 10 rupees on 100 rupees, that is close to 10%, correct? Second option is buying it in the derivatives market. Earlier in option 1 we were talking about cash market. Derivative markets has further 2 options. First option is to invest through futures and the second option is to invest through options. Options are call options and put options. So call option typically means that when you are betting on the upside potential of a stock, basically when you are believing that this stock will rise from 100 to 110 in a very quick span of time, you buy that call option. And the benefit of buying a call option or a future option is that you can invest far lesser money that you have invested in the stock market, in the cash market, than you have to invest over here. Say if you're buying a future, then you have to invest just 20 rupees and then if the stock price rises from 100 to 110, then you can make 10 rupees of profit on an investment of just 20 rupees. So now your ROI is 50% versus 10% that was there in the case of cash market. Now in the case of call option, you might have to just, again at the risk of oversimplifying it, you might just have to invest 1 rupee, and if the stock prices rises to 110 rupees quickly, then you make a profit of 10 rupees on an investment of just 1 rupee. So this investment grows from 1 to 10, that is 1 to 11. So your return on investment is close to 1000%. This is what attracted the stock market investors to move from cash market to futures and options market. But how big is the extent? So on one particular day, SEBI observed that if the bank nifty constituents were traded worth rupees 30,000 crores approximately in the cash market, its equivalent value traded in the options market was 103 lakh crore rupees. Yes, in just one single day. So this is 353 times the value invested in options market vis-a-vis cash market. I'm not talking about the absolute investment, I'm talking about the worth of securities being traded in the options market versus the cash market. Let's not confuse it and let's move on. Now what did Jane Street do? In case of Bank Nifty, there are typically 12 stocks, right? So from 9:15 a.m. when the markets opened until 11:50 a.m. they used to buy these shares, these 12 Bank Nifty constituents in huge quantities, which used to drive up the share prices, and these used to be, and their quantities used to be as high as 25% of the total buy quantity that was purchased during this period. So this definitely used to take the share prices up of these particular Bank Nifty constituents. In that same time period, they used to buy put options of these particular index, the Bank Nifty index, and it used to later dump these shares from 11:50 a.m. to 3:30 p.m. of the same day during the market hours, so that it can profit from the underlying put options that it has purchased. In one single day, on 17 January 2024, Jane Street made 730 crore rupees worth of profit, whereas it definitely lost some amount in futures and cash market that was worth around 60 crores. But by the extent of leverage that an investor gets in put options through put options is not something that they can get through cash markets, right? So that is why they made 10 times the profit in put options, but they lost just 10% of the total profits made in cash markets and future markets. And this is how, over the 21 most profitable days, using another strategy that is called extending market, the close strategy, Jane Street made more than 4,800 crore rupees worth of illegal gains as per SEBI. And that amount, 4,800 crores, more than that, has been asked by SEBI to be impounded. Now, SEBI is going to study this pattern for the last 2.5 years, 2.25 years, for which Jane Street was operating, that is from 1st January 2023 to 31st March 2025, and find out whether more amount of sums have to be impounded. The interesting part over here is that Jane Street knew about this in February. NSE emailed them, they summoned Jane Street and told them to not deploy these strategies, and despite that, it was found on 15th May 2025. After agreeing to all these conditions imposed by NSE and SEBI, the Jane Street Group still deployed this strategy on Nifty 50 index options and made profits, tried to make profits out of it. So this was obviously very thick-skinned attitude that Jane Street applied, but glad that 4,800 crore worth of securities have been asked to be impounded in this case. But the underlying here for retail investors is that they need to understand if they are going to make profits from the markets or not, because people with more muscle power are going to outsmart you by manipulating the markets. So of course this is a positive step in making the markets a more fair place, but retail investors, the retail traders, need to understand that F&O is eventually a zero-sum game. So whether they should be dabbling into this process or not is their call, and it's very wise for them. The answer is very simple for them to understand whether to participate in these derivatives or not. If you want a more detailed explanation on this topic, you can go to my channel, that is Kanan Bahl, and understand this. We'll be soon uploading a video over there. Until then, stay connected. Jai Hind and thank you.